Yet again, I'm back, your host, in today's video presentation. Lwando Franklin is my name, the lead tutor, Chief Executive Officer, the pioneer of SCL Accountants Tuition Center. In today's video presentation, I'm going to look at IAS 21, foreign currency transactions, and also IAS 16, accounting for non-current assets. I also look at the complex asset. This video is relevant for students who are studying CA 3.1 under ZICA, and those who are studying strategic business reporting under SCCA. I just want to encourage all the viewers to ensure that they ask questions relating to today's question. All the questions will be taken very, very seriously. And depending on the availability of time, we are going to respond to them. I also want to encourage our viewers to ensure that they make comments in the comment section of this video. The comments raised will be used to ensure that we improve our presentation. So now, let's look at this question. On 1 April 2022, ZICA Munobe purchased a machine from a foreign supplier based in Zimbabwe. The cost of the machine was 900,000 Zimbabwean dollar. ZICA Munobe paid this amount to the supplier on 30th June 2022. That is the settlement date. The estimated use life of the machine at 1 April 2022 was 8 years. However, the machine contains a component which will need replacing after 4 years. On 1 April 2022, the directors of ZICA Munobe estimated that 30% of the original cost of the machine was attributed to this component. Relevant exchange rates are given. ZICA Munobe uses the cost model to measure all of its property, plant, and equipment required using the information in Note 1 and 2. We are looking at Note 2. Show how the two events would be reported in the financial statements of ZICA Munobe for the year ended 31st March 2023. Now, I just want to explain on monetary items and non-monetary items. Non-monetary items are not retranslated. These refer to machines, the buildings, the purchases, the revenue. These will remain the same when translated on the date of transaction. Monetary items need to be retranslated at the reporting date, if not yet settled, or at the settlement date if it comes earlier. These monetary items refer to accounts payable, accounts receivable. They need to be retranslated, and the exchange difference will immediately be reported to the statement of profit and loss because the transaction took place and the profit or loss are immediately realized. So now, the exchange rate, there they are given, exchange rate Zimbabwean dollar to 1 kwacha So which means the 3 kwacha there is Zimbabwean dollar. The 2.5 there is Zimbabwean dollar. The 2.4 is Zimbabwean dollar. Now the amount exposed to the risk is also in dollars. So the exchange rate is compatible to the amount exposed to the risk, and to translate, you divide. So now let's look at the date of transaction. On the date of transaction, which we are given, that is 1st April. So we have the date of transaction is 1st April 2022. So we are going to translate. We have the 900,000 divide by, on April, the exchange rate is 3. So divide by 3. This will give us 300,000 kwacha. This is 300,000 kwacha. The journal entry will be debit machinery, with 300,000 kwacha. Credit accounts payable, because we have not yet settled. Is that okay now? So that will be the journal entry. Machine is a non-monetary item. It will remain at 300,000 kwacha in the books of Zika Munobe. The accounts payable is a monetary item which will be retranslated at the settlement date or at the reporting date, whichever comes earlier. So now, on 30th June, it was settled when the exchange rate was 2.5. So there now, settlement date, 30th June, 2022. So there we have 900,000 divided by the exchange rate, 2.5. This gives us 360. Now the accounts payable has increased, which means there is exchange difference, which is a loss. The journal entry here will be debit the P&L with the loss of 60,000. Credit the payables, because in the payables accounts, we already have the 300,000. So you increase it by 60. So that is how you deal with the monetary item. Now we are told this asset has 2 components. A component that will be replaced after 4 years, and another component which has expected useful life of 8 years. Now I want to explain that this is an example of a complex asset. A complex asset is one which has different components with different related expected useful life, and the depreciation must be calculated for each component. So now we go to the one which has 4 years. Component. We are told this is equal to 30%. 30% of 300,000 multiplied by Sorry, this is 90,000. Divide by 4 years. Multiply by 1 year. This gives us 22,500. The remaining component, it has 8 years, which is automatically 70%. 70% of 300,000, which will be 210. Divide by 8 years, multiply by 1 year. This gives us 26, or rather we can say 26 years, 26,250. So now the total depreciation, which will be 22,500 plus 26,250. The total here will be 48. It will be 48,750. This amount to be charged to P&L. The carrying value of the machine will be 300,000. Less 48,750. This will give us 251. $251,250. That's what will be reported in the statement of financial position. So we have answered this question conclusively. And for today, we are going to end here. I just want to encourage the new subscribers to ensure that you hit the notification button so that every time when new videos are available, you are notified. Also, like the video and share with others. Now, I just want to thank all our viewers for the support you've been giving us. Thank you, and may the Almighty God Jehovah bless you beyond measure.